I want to start with a warning I have been watching build for several years, not a prediction, not a theory, a mechanical sequence that I have studied across every major long-term debt cycle in modern history. And I want to ask you directly, do you understand what happens when the buyers of government debt disappear? Not slow down, disappear. When the largest, most liquid bond market in the world runs out of willing buyers at prices the government can afford, because that sequence has happened before, not to the United States, not yet. But I have spent 50 years studying the template. I have watched it play out in country after country. And what I am watching in the American Treasury market right now, in the auction data, in the bid to cover ratios, in the Federal Reserve's own balance sheet, tells me that the United States is closer to that moment than at any point in my career. Write this down. Because once you understand the mechanism, you will never look at a Treasury auction result the same way again. And once you understand what history says comes next, you will understand why I believe the most important wealth preservation decision of the next decade is being made right now, today, by the investors who understand this and the far larger number who do not. Subscribe now. Let me start with the mechanism, because in 50 years of studying debt cycles, I have learned one thing above everything else. The mechanism always precedes the crisis. The crisis does not create the mechanism, it reveals it. The mechanism operating in the American Treasury market right now is simple. The United States government must sell bonds to finance its deficit. Every week it holds auctions. Primary dealers, foreign central banks, pension funds, money market funds, and institutional investors bid on those bonds. When demand is strong, yields stay low and the government borrows cheaply. When demand weakens, yields must rise to attract buyers. And here is the number that tells me demand is weakening right now. The bid to cover ratio on the most recent 30-year Treasury auction fell to 1.97, below 2. For the first time since 2023. The bid to cover ratio is the single most honest measure of Treasury market health because it cannot be managed. It is the ratio of total bids received to the amount of bonds the Treasury is trying to sell. A ratio above 2 means healthy demand. Below 2 means the market is struggling to absorb what the government needs to sell, and the government needs to sell an enormous amount. The United States is running a deficit of approximately $1.8 trillion annually. On top of that, it must refinance $9.2 trillion in maturing debt this fiscal year alone. That combined issuance requirement is the largest in American history, and the buyer base has been shrinking for years. Foreign central banks, which once held nearly half of all outstanding U.S. government debt, now hold less than 29%. The Federal Reserve, which bought aggressively during the pandemic, has been attempting to reduce its holdings. And now the bid to cover ratio is falling below 2. These three facts together are not coincidence. They are the early symptoms of what I call the demand wall. The moment when the supply of bonds exceeds the demand for them at sustainable yields. I have watched this wall approach in every country that reached the late stage of its long-term debt cycle. And I have never watched it approach without knowing exactly what comes next. Now I want to show you where we are in the long-term debt cycle, because this is the framework that gives all of these individual data points their meaning. The long-term debt cycle is a 50 to 75-year arc that I have studied across every major economy in modern history. It begins when a country establishes itself as a creditor nation with a trusted currency and strong institutions. It ends when the accumulated weight of debt relative to income makes it impossible to service that debt without either defaulting or debasing the currency. The United States began its current long-term debt cycle at the end of World War II, when the dollar became the world's reserve currency, and American debt was the world's safest asset. For decades, the cycle was in its productive phase. Debt grew, but income grew faster. The debt burden was manageable, and the credibility of the monetary system was intact. The cycle began its late stage in 1971 when Nixon closed the gold window and the dollar's anchor to a physical asset was severed. From that moment, the ability to create dollar-denominated debt became limited only by the willingness of the world to hold it. And the world was willing to hold it for a long time because the dollar's reserve currency status, the depth of the Treasury market, and the strength of American institutions created a structural demand for dollar assets that had no alternative. That structural demand is now weakening, not collapsing, weakening. Foreign central banks hold 29% of American debt, down from 48% in the year 2000. The bid to cover ratio on the 30-year bond fell below 2 for the first time in 3 years, and the Federal Reserve, which is supposed to be the institution that manages monetary policy, is already purchasing $40 billion per month in Treasury securities under a program it calls reserve management purchases. In 50 years of studying debt cycles, I have never seen the lender of last resort become the buyer of first resort without it marking the beginning of the monetization phase of a long-term debt cycle. That is where we are. And the monetization phase always has the same consequence for the currency being monetized and for the asset that has no currency to monetize. I want to be precise about what the monetization phase looks like from the inside, because when you are inside it, it does not look like a crisis. It looks like policy. It looks like management. It looks like the Federal Reserve doing what the Federal Reserve is supposed to do, $40 billion per month in reserve management purchases. That is not a crisis announcement. That is a technical program with a careful name. But I want you to understand what it actually is. The Federal Reserve is creating new money and using it to purchase United States government bonds that the private market is not absorbing fast enough at existing prices. That is the definition of debt monetization. It is what every central bank in history has done when the arithmetic of its government's fiscal position exceeded what the private market could finance at sustainable interest rates. It is what the Weimar Republic did in the 1920s. It is what Japan has done for 30 years with its yield curve control program. It is what the Bank of England did in September 2022 when the gilt market collapsed in 48 hours after the Truss government announced unfunded tax cuts. Each of those episodes has the same structure. The government needs more financing than the market will provide at affordable rates. The central bank steps in. The currency is debased in real terms, even if nominal values remain stable. And the asset that cannot be debased because no government issued it and no central bank can create more of it rises in terms of the debased currency. I have watched this happen in country after country across 50 years of studying these cycles. The names change, the mechanism does not. What I am describing is not a prediction about what might happen to the United States. It is a description of what is already happening, operating at $40 billion per month under a name that does not use the word monetization. The question is not whether the mechanism is operating, it is. The question is how fast it accelerates from here. Now, I want to walk you through the 4 signals I am watching most closely to track the progression of this cycle, because understanding where we are in the sequence is everything. The first signal is the 30-year Treasury yield. It briefly touched 5% in April of this year. 5% on a 30-year Treasury bond is the level at which the debt service arithmetic on $39 trillion in total federal debt becomes publicly and undeniably unsustainable. At 5%, the annual interest cost on the outstanding debt approaches $2 trillion annually. That is more than the entire federal discretionary budget. When the market begins pricing the 30-year bond at 5% on a sustained basis, it is telling you that the buyer base is demanding compensation for a risk that it did not previously price, the risk of monetization. The second signal is the Federal Reserve's language around its purchase programs. Right now, the Fed describes reserve management purchases as a technical balance sheet operation. When that language begins to change, when officials acknowledge that the purchases are serving a market support function rather than a balance sheet management function, that is the signal that the monetization phase has become official rather than technical. Watch what the Fed says about why it is buying, not how much it is buying. The third signal is the central bank gold accumulation rate. Central banks have purchased gold at double the historical average for 3 consecutive years. 1,037 tons in 2023, 1,045 in 2024, 863 in 2025. These institutions are not buying gold as an investment. They are buying it as a hedge against the monetization of the currencies they hold as reserves. When the world's most sophisticated sovereign capital allocators buy gold at double the historical average for 3 consecutive years, they are pricing something the retail investor has not yet priced. The fourth signal is the gold to Treasury ratio in global central bank reserves. Gold has now overtaken U.S. Treasuries as the largest reserve asset held by central banks globally. That crossover is the single most important structural signal in the monetary system since the Nixon shock of 1971. It means the institution that manages global monetary policy has concluded that gold is now a more reliable store of monetary value than American government debt. When central banks collectively reach that conclusion, the long-term debt cycle is in its final phase, the monetization phase. And in the monetization phase, the direction of gold is not a question, it is arithmetic. I want to close with what I have consistently observed across every long-term debt cycle I have studied. There are two types of investors who live through the monetization phase of a debt cycle. The first type watches the government's nominal accounts and concludes that because the numbers appear stable, the system is stable. They hold their wealth in the assets that the monetization is eroding: treasury bonds, cash, dollar-denominated savings accounts. They are comfortable because the nominal values are not crashing. They do not understand that nominal stability during a monetization phase is itself the mechanism of wealth transfer. Their savings appear intact in dollar terms, while purchasing power is silently redistributed to the holders of real assets. They will understand what happened only after the cycle completes, when the prices of everything they need have risen faster than the value of the dollars they saved. The second type of investor understands the long-term debt cycle. They have studied what happened in every previous monetization phase. They know that the assets that preserve wealth through a monetization are not the assets that perform best during the productive phase of the debt cycle. They are the assets that exist outside the monetary system being monetized: physical gold, silver, real assets whose value is not a function of the creditworthiness of any government. I have been studying these cycles for 50 years. I have watched the productive phase and the monetization phase in country after country. The cycle always completes the same way. The monetization always produces the same outcome for the currency. And gold, which has no monetary system to be swept up in, no central bank to debase it, no government that can decide to print more of it, has always been on the right side of that outcome. The bid to cover ratio on the 30-year Treasury fell below 2 last month. The Federal Reserve is buying $40 billion per month in government bonds. Central banks have purchased gold at double the historical average for 3 consecutive years. And gold has now overtaken U.S. Treasuries as the largest reserve asset in the global monetary system. I have never seen those four signals converge simultaneously in any previous cycle. The long-term debt cycle is in its final phase. The investors who understand what that means are not holding their wealth in the asset being monetized. Now you understand what they understand.